Hello, Business 330 students. This is Professor Hassey, and this is my week 2 Saturday/weekend update video for this Saturday, Labor Day weekend, September 2nd, 2023. A couple of things to note for this Saturday heading into the Labor Day weekend. Assignment number 1 is due on Sunday, tomorrow, September 3rd at midnight. If you need an extension, please email me and let me know if you need some extra time. Again, no problem. Just don't forget to remember to do that. Also, tomorrow, Sunday, September 3rd, I will be posting assignment number 2, which will cover material from Chapter 5, The Time Value of Money. There'll be a lecture video posted on Monday, Labor Day, that's going to talk about this assignment, but it will be posted on Sunday, and you can download it and begin your work on it. One of the questions on the assignment number 2 will to update your portfolio spreadsheet as of Friday, September 8th, at the close of the markets this Friday, September 8th. So we'll be updating our portfolio and seeing if we've made any money these first 3 weeks of our class. Today, we're going to have a brief video explaining one more time financial statements, the subject of our discussions for this week number 2. Before I get to that, though, I'd just like you all, I have posted all the grades up to this point in time through week 2. Naturally, the assignment number 1 grades are not posted yet, but I do have those grades posted for your portfolio presentation and spreadsheet and for your student bio. And if you spoke with me in the professor meetings this week, and I appreciate all of you coming on this week and chatting with me just for a few minutes, just to make sure I see who you are and you can see who I am, but also make sure you're feeling good about our course thus far. So those grades are all posted. Now, if you do not have a grade, it means I have yet to receive that work. And please complete that work as soon as possible to Blackboard. If you have a grade and you have a statement in your discussion forum, like, could you please resubmit your portfolio because certain things were left out, please do so and send that updated portfolio in, and I will reevaluate your grade for that work. So this is a good time this weekend is to double check your Blackboard Grade Center and make sure all your grades, all your work is posted, the student bio, the portfolio, and that you have seen me in the professor-student meeting. If any of those are 0, please act accordingly to take care of those so to get off to a good start. Remember, those 2 assignments are 15% of your grade plus this week's assignment number 1, which is 10% of your grade. So that's 25% of your grade through this Sunday, September 3rd. So please make sure you understand that. And if there's any open items or any questions that you have, please make sure you get in contact with me via email, the discussion post, or if you want a Zoom call, we can do that as well. So that's where we stand heading into this close of week 2. I think by the whole, everybody's in pretty good shape. We had some good chats on the professor meetings, and I appreciate all your work you're putting into this course thus far, but a lot more work to do. So let's take a video highlighting and again talking about our discussions of this week number 2.
How does financial ratio analysis work? Let's discuss 10 of the most popular financial ratios that can help you find the story behind the numbers. What do you need to get started on a financial ratio analysis? You need an income statement, the overview of how much profit a company made during a year. You also need a balance sheet, an overview of what a company owns and what a company owes at a specific point in time. We will start off with financial ratios that only focus on the income statement, then look at financial ratios that only focus on the balance sheet, and end with powerful financial ratios that combine information from the income statement and the balance sheet. Performing a financial ratio analysis has a scientific element to it. finding data and putting it into formulas, as well as an artistic element, assigning meaning to the outcome of the calculations and seeing the big picture.
As I'm in the midst of applying for residency right now, wish me luck, Grammarly has again been a lifesaver with my application and
Part 1. Financial ratios that only focus on the income statement or profit and loss statement, P&L. Let's compare the income statements of two fictitious companies, which unlike real-life companies have nice round numbers in their financial statements. The first step in financial ratio analysis of the income statement is to make everything relative. Relative to sales, that is. Each of the cost line items and profit subtotals is expressed as a percentage of revenue. Let's see what the financial ratios tell us. Company A has a gross profit margin of 50%, Company B of 30%. So the gross profit margin is 20 percentage points higher for Company A. Company A makes far more margin than Company B on the products or services it sells. Company A has an operating margin of 21%, while Company B has an operating margin of 14%. So the 20 percentage points difference, 50% versus 30%, on the gross profit level has shrunk to 7 percentage points, 21% versus 14%, on the operating margin level. Net income as a percentage of sales, often called return on sales, is 16% for Company A and 8% for Company B. What do we zoom in on for further analysis? Let's investigate the difference between gross profit and operating margin. This is mainly driven by selling, general and administrative expenses. 20% of revenue in Company A, 10% of revenue in Company B. The non-manufacturing costs for functional departments like sales, marketing, finance, HR, sourcing, legal and IT are far higher for Company A than for Company B. This could be related to the industry each company is in, the company's strategy, or the level of efficiency that it has achieved. Could Company A be overspending in SG&A, or is Company B underspending? Hard to say just from these numbers, but worth investigating. On the research and development line, Company A is spending more than Company B. This is usually seen as a good thing, as today's research and development expenses hopefully lead to high margin innovative products and services to sell in the future. Part 2. Financial ratios that only focus on the balance sheet. The first question that I always ask myself is, how is the company doing on liquidity? Is it likely to be able to pay its bills in the short term? Let's look at the current assets, cash plus items that are likely to convert to cash within a year, versus the current liabilities, items that need to be paid with cash within a year. A useful financial ratio in this area is the current ratio. Simply divide the current assets by the current liabilities. For Company A, 400 divided by 200 is 2. For every dollar of current liabilities, there are $2 of current assets, a safe position from the perspective of business continuity. For Company B, 200 divided by 400 is 0.5. For every dollar of current liabilities, there is only 50 cents of current assets, a more risky position, for a supplier that is hoping to get paid. While on the topic of current assets and current liabilities, let's calculate the amount of working capital utilized by the companies. Accounts receivable plus inventories minus accounts payable. For Company A, this is 150 plus 200 minus 200, in total 150. For Company B, this is 50 plus 100 minus 300, in total negative 150. Company B seems to be getting paid by customers before they have to pay suppliers and holds a low level of stock. The next financial ratio is all about the company's financing strategy. Does it primarily borrow money to finance operations or rely on capital provided by the shareholders? The debt to equity ratio can help you put that in perspective. For Company A, 100 in borrowings, 700 in equity. So a debt to equity ratio of 1 to 7. You could call this a conservative and robust way of financing with a big buffer of equity that helps defend the business continuity of the company in case of future losses. For company B, 400 in borrowings, 100 in equity, so a debt to equity ratio of 4:1. For every dollar of shareholder capital, equity, there are $4 borrowed, which is possibly more fragile. A related financial ratio is equity as percentage of the balance sheet total. 70% for company A, 12.5% for company B. Based on the debt to equity ratio and equity as percentage of total, you could say that company A has low leverage, while company B has a high leverage.
Sick of hiring setters that barely book calls for your business? Use AI instead. We use 5 different...
Part 3. Financial ratios that combine information from the income statement and the balance sheet. This is where you might see new storylines and connections, on top of what you discovered in analyzing the income statement individually and the balance sheet individually. Let's start with a big picture financial ratio called return on equity, which is net income divided by equity. For company A, 160 divided by 700, which is 22.9%. For company B, 80 divided by 100, which is 80%. On the return on equity metric, company B far outperforms company A. What is driving that? While company A has higher profit margins, as we saw in the income statement analysis, company B has a much higher financial leverage, as we saw in the balance sheet analysis. There is a third component to the return on equity calculation, the financial ratio called asset turnover. Asset turnover looks at how much revenue is generated by the company with the assets it has. For company A, asset turnover is 1. 1,000 in assets on the balance sheet generates 1,000 in revenue in the income statement. For company B, asset turnover is 1.25. Let's dig a little deeper into 2 key subsets of this asset turnover ratio. The first one is receivables turnover, the number of times per year that the business collects its average accounts receivable, the ratio between revenue in the income statement and accounts receivable on the balance sheet. 6.67 for company A, 20 for company B. Receivables turnover might be a bit abstract for a lot of people, so let's turn it into a more tangible related metric called days sales outstanding. How many days does a company need to wait before a customer pays? 55 days for company A and just 18 days for company B. The second subset of the asset turnover ratio is inventory turnover, the number of times per year that the business turns its inventory, the ratio between revenue in the income statement and inventory on the balance sheet. 5 inventory turns for company A, 10 inventory turns for company B. So what do financial ratios tell us? Can we say, based on calculating these financial ratios, that company A is in better financial shape or company B is in better financial shape? Not necessarily. Financial ratios do provide us with clear information about the financial footprint of a company and deepen your understanding of the strategic and operational story behind the financial numbers. In this video on financial ratio analysis, we covered 10 financial ratios. On the income statement, gross profit percentage, operating margin percentage, return on sales percentage. On the balance sheet, current ratio, debt to equity, equity as percentage of total. When linking the P&L and the balance sheet, return on equity, asset turnover, receivables turnover, inventory turnover. Financial ratio analysis is as much an art as it is a science. Want to learn more about business, finance and accounting?
Critical to financial statement analysis. That's because we can use ratios to analyze a company's performance over time, spotting any trends or changes in profitability, leverage, or other factors. But we can also use ratios to analyze a company's performance compared to that of its competition. We can look at competitor A and competitor B and say, how does their profit margins compare to the company that we're looking at? So people generally put ratios into 5 different categories. Okay, so we got profitability ratios, short-term liquidity, long-term solvency, activity, aka efficiency ratios, and market value ratios. I'm going to go over each of these categories in more detail in the videos to come, but I just want to give you a general overview here. So profitability ratios is margins and rates of return. So there's really two different types of profitability ratios, and they tell you different things. Margins are things like gross margin, operating margin, profit margin. They tell you about a company's ability to manage its expenses. They can also tell you a little bit about the company's strategy, because like companies, for example, that tend to have like higher prices and be more like a differentiator type strategy with like a higher quality product, you might expect them to have higher profit margins. Now, rates of return are also related to profit, but what we're doing with rates of return, we have things like return on assets, return on equity, return on invested capital. What we're doing with each of those is we're taking some measure of profit, usually net income, and dividing it by something. So for example, ROA, we take net income and divide it by the company's average total assets. That gives us an idea of how profitable the company is given the assets it has at its disposal. And that's really helpful if you're comparing two companies. Let's say you're comparing Company A and Company B, and Company A is a lot larger than Company B. You would expect Company A to have more profit if you just look at net income because it's a larger company. But when we scale net income by total assets, right now we're getting an idea, okay, how good are you at generating profit given the assets you have? Okay, and then return on equity, thinking how good are you at generating returns for your equity holders in terms of profitability. We'll go over those in more detail. We can even decompose ROA and ROE into their component parts. Now, short-term liquidity has to do with, is this company going to be able to pay their bills in the next year? Are there going to be any problems with, right now, next 12 months, is this company going to have any issues where they're not able to pay their suppliers or something like that? We've got different measures. We've got the current ratio. We've got the quick ratio. Long-term solvency also has to do with the company's ability to pay its bills, but we're thinking beyond this year. So we've got a couple different types of long-term solvency ratios. We've got a lot of different types of debt ratios. With debt ratio, is trying to measure how leveraged is this company? Like how much have they borrowed? Okay, so how much debt do they have? And there are different ways we can measure debt ratio. For example, we can look at like long-term debt divided by total assets. And you say, well, what does that tell us? Well, if one company, 60% of their total assets are financed by long-term debt, but another company is just like 10% of their assets are financed by long-term debt, we'd say, okay, well, this one is a lot more leverage. They have a lot more debt. But just because a company has more debt doesn't mean it's not going to be able to pay the interest and repay the principal on the debt. And that's where we come in with coverage ratios. Coverage ratios, like, for example, interest coverage ratio, we're looking at a measure of profitability, basically as a multiple of the interest expense that the company's incurring. So we're looking at, okay, just because you have a lot of debt and you got a lot of interest doesn't mean you're not going to be able to pay it. If you have a lot more profit than you have interest, then you're going to be okay. Now, if you start losing money, then we got a problem. And that's, one of the issues with leverage, right? The interest has to be paid whether or not the company is profitable. Now, activity ratios, aka efficiency ratios, we can think about things like the asset turnover, account receivable turnover, inventory turnover. And so whenever you hear like turnover, think, okay, this is an activity ratio. Activity ratios are really helpful. So like asset turnover is tell us like how efficient is this company at using the assets it has to generate sales. Okay, so that's asset turnover. But we can also think like inventory turnover. How many times a year does this company sell through its inventory? And then we can actually convert that. We can convert inventory turnover to days to sell inventory. And then there's things like account payable turnover. We can convert that to how many days does it take the company to pay its suppliers. Then we're going to use those things. Okay, when we get the days payable, there are days to pay the suppliers, days to sell the inventory, days to collect receivables. When we get all those, we can actually calculate the company's cash conversion cycle, its operating cycle. We're going to go over that in a lot more detail. I know I'm throwing a lot of terms at you right now. I'm just trying to give you an overview, but we can do a lot of exciting stuff. It's really helpful to know how long does it take this company to sell its inventory. Is it 28 days? Is it whatever? And what if it's getting worse over time? What if it was 28 and then now it's 41 and then now it's like 52? We say, wow, it's taking longer and longer for this company to sell through its inventory. Maybe some of the inventory is obsolete if we're talking about a technology company or something or whatever. So this is really helpful. We're going to be able to do a lot with these activity ratios. Now, market value ratios, looking at things like the market to book ratio, the PE ratio, And now we're getting into things when people call it like market value ratios. What we're thinking about is like, is this company what we call like a value stock, or is this a growth stock? Okay. And when we talk, I'll have a video where I talk about value stocks versus growth stocks, but let's just take the PE ratio, for example. Okay, let's just use that one example here. Let's say you have a company with a PE ratio of $10, and then you have another company with a PE ratio of $90. Basically, one way of thinking about this is someone is saying like, well, for this company, someone's willing to pay $10 for $1 of earnings, whereas this company, someone will pay $90 for $1 of earnings. And we say, well, why would there be such a discrepancy? Well, people think that this company here in the future is got a lot more growth opportunities, and so they're not just paying that $90. It's just like, oh, $1 of earnings today. In the future, this company's actually going, the earnings are going to grow dramatically, whereas this company, maybe the earnings are just going to remain stagnant. They're just going to be flat. And so we'll talk about each of these different categories. I'll go through a lot of different ratios, and I'll show you how to apply them to actual companies with some real numbers in the videos to come.
Okay, there's a couple of videos highlighting what financial statements are, especially the income statement and the balance sheet, and financial statement analysis of taking information in the real world of financial statements and telling you what it says about a country. Some of the questions that you're doing in this week's assignment number 1. So make sure you check your grade status, and if you have any open items as far as week 1 discussion posts, and if you have yet to visit me in our student professor meeting this past week, please review that, look at your status, and make sure you're okay with where that stands. As I said earlier, I'll be posting assignment 2 on Sunday, tomorrow, and then the video explaining week number 3 will be posted on Monday on Labor Day. So have a safe and fun Labor Day weekend, everybody. And thank you for all your efforts these first couple of weeks of our class. And we'll see you in just a couple of days. Adios.